One of the biggest reasons why smart money traders fail is if ICT doesn't teach something, traders don't investigate it. Instead, they chase down every rabbit hole, which ICT says is the new secret enigma. In this video, I'm going to show you why volume is one of the most important things you need to understand in order to be consistently profitable. Now, what does ICT say? ICT says that all price is strictly governed by a master algorithm and price doesn't move due to institutional orders or institutional volume. This is nonsense. The algorithm is a delicate interplay between efficiently matching buyers and sellers and receiving feedback from the volume of institutional traders to move price to different levels. Now, as traders, what do we need? We need volatility. There's nothing worse than seeing your entry criteria fulfilled and then price not moving. Okay, why doesn't price move? Because it needs to be driven by institutional volume. In this video, I'm going to show you exactly how you can understand the relationship between volume and price moving. So this is a tool called Edgeful. Edgeful contains powerful statistics which allow you to either find or refine your trading edge. If you would like access to this amazing tool, then there's a free 7-day trial in the description of this video. So the report I want to show you today is a volume report. It's the intraday volume by range, and I'm going to do it for NQ using 3 years worth of data. Now, this is very interesting. So what this shows you, the blue bars are volume and the white plots are range. So you can see that the range changes throughout the day, as does the volume. Okay, there's a relationship between the range of the candles and the volume. You do not want to be trading when the range becomes too small, because essentially you'll be entering a consolidatory period where you're likely to be taken out in some form of accumulation or seek and destroy. Now, I've run the data between the open 9:30 a.m. and the close, and each of these bars is equivalent to a 15-minute candle. You can, of course, customize the report and extend the range, as well as looking at the additional tickers such as gold, platinum, oil, and so forth. So what this report allows you to do is to know when you should stop trading because the volume and thus the range of the candles is too small, and you're unlikely to get that nice expansion you need in order to TP. So you'll see at 9:30 a.m., that is when you have the highest volume of the day. Okay, and then you get another peak at 10 a.m. We then taper off, and then the last peak is at 11:30 a.m. After that, it is consolidatory price action. Okay, the range becomes very, very small, and you're unlikely to get any further movement. What does this mean for your trading? After this last pump at 11:30, you should either be looking to close out your trade, take partial profits, or at least state your stop loss to break even so you don't get chopped up. Okay, this is where you want to be taking your trades. Okay, between the open and closing it out at 11:30. Between 11:30 and 1:45, you had that dead price action until we pick up again at 1:45. And we have that last movement, and we have a great pump during power hour from around 3 p.m. till 3:45, 4 p.m. when the market closes. Okay, if you stay out of this price action from around 11:30 until 1:45, you reduce the likelihood of getting chopped up and taking losses. Okay, these are your two periods where you're going to get high volume, high institutional volume, which will allow the candles to move. Understand that you should be using all of the data you have for your trading. And if you've only been looking at price action so far and you haven't been looking at volume, you could essentially double the technical analysis that you can do in order to become a more profitable trader. If you would like to learn how I trade time and price using my golden bullet trading strategy, which I use for index futures, forex, metals, energies, and cryptos, there's a link to my mentorship below.